Following the meltdown on Thursday, the markets closed on a relatively quiet note on Friday. Although European indices continued to tail down between 0.5 and 1%, the Dow actually increased by around 60 points, the reason being that the Moody's downgrades weren't as bad as had been expected. Looking at Europe for a moment, Spain finished the week on a high, with Spanish bond yields actually down on the 10-year mark by around 90 points from where they'd started to about 6.4%. In terms of Greece as well, hope springs eternal there. The new Greek government is asking to actually push out deadlines in terms of fiscal targets for about 2 years. Also, they want to scrap the cuts to government service of around 150,000 jobs. And in a disturbing parallel to New Zealand, they're looking at raising around 50 billion euros in terms of asset sales. Looking at currencies then, the dollar was actually in a relatively narrow band against the US, up at one stage to around 79.14 against the US, but hovering at around the 79-cent mark. The sale of Crayford land earlier this year provoked the debate around foreign ownership of New Zealand agricultural land. It's interesting to note, though, that New Zealand isn't the only place where this is an issue. Our closest neighbour, Australia, also has significant issues around ownership of foreign land. So much so that it's provoked a report. Looking at data released by the Australian Bureau of Statistics, around 11% of Australia's more than 135,000 agricultural businesses are partly or wholly foreign owned. That includes also around 11% of Australia's agricultural land. Of course, it's really interesting to see who's the foreigner in terms of the Australian context. Looking at dairy, for example, around 45% of Australia's milk production is processed by Kirin and, of course, our own Fonterra. And in terms of meat processing, the largest single processor in the country, with around 15% of the market share, is actually Brazilian. Interestingly enough, the Australian government believes that foreign inflows of capital is extremely important to agriculture. And in their view, concessions to sovereignty will have a significant economic cost to countries who actually restrict that inflow of foreign capital.